So today we're going to talk about loans and credit cards. So I think these two things tie really nicely into each other. First, we'll be covering credit cards with credit scores, interest rates, what credit risk is, and how to start applying for your credit cards. And then we'll move on to loans, where we'll go through some definitions, which I know, trust me, it can get really boring, but they're important. And then we'll talk about interest rates in relation to loans versus credit cards. Then we'll talk about some loan terms like amortization, and we'll end with different types of loans you'll probably encounter within your life.
So, a credit card is a card with a spending limit issued by a financial service company, normally a bank or a credit union, for consumers to use and pay back later. How they typically work is the cardholder will apply and get approved to borrow funds, and then up to a certain spending limit, they have to pay it back what they borrow plus the interest and any additional fees or charges for using that service. And then for a credit scores are super important because they're a number between 300 and 850, and they show someone's credit worthiness, which is how likely they are to pay back a lender. And the higher the credit score, the better it is for a potential borrower, and the more likely they are to be approved for whatever they're applying for. And then credit scores are super important because they can have a huge impact on someone's financial life. Lenders use them to determine if they should give someone a loan, like mortgages and car payments and credit cards, and they reflect the probability that an individual will pay them back on time. They're reported by three main agencies: Experian, Equifax, and TransUnion. There are some minor differences between them, but they all base them on the same 5 factors. And then how they are determined: they're determined based on your history, your credit utilization, the length of the history, the new inquiries you have, and then the mix of credit that you have. And then on the right is a graphic of the credit ranges, typically considered between bad and excellent, and oftentimes lenders will have a minimum in somewhere in the fair range of they won't give loans if you're below it. And then for more on how they're determined, for payment history is the biggest category for the credit score. So you just have to pay your bills on time. And if you have a late payment or you miss payments, it can be on your credit report and held against you for up to 7 years. The next most important category is utilization. So the lower the percentage of your available credit you use, the better. It's recommended to stay under 30% maximum, but the lower is better. So for example, student or beginner cards often have a starting out $500 limit, so you shouldn't be using more than $150 at a time. And if you're getting close to that limit, you can pay bills early, or you can ask for to up your credit line. And for new inquiries, applying for new loans can lower your credit score, so it's best not to apply for a lot of them. And then for credit mix, having a combination of loans or fixed payments and revolving credit will all benefit you. And then for length of history, it's important to have a long length of history to show that you can consistently be paying it back. And so you should take advantage of student credit card options and start now. And it will also lower your credit score if you keep opening and closing accounts. So when you want to be done with an account, you should do what's called sock drawing it, which is where you just spend up to the minimum so you can keep the card active.
Alrighty, so now we're going to get into a little bit about interest rates. So interest rates is essentially the price that you pay to borrow money from the bank. And within credit cards, you're going to probably see an APR, which is annual percentage rate. So these are just the interest rates stated at a yearly rate. For example, you're going to borrow $100 and it has a 2% APR. That means you're going to have to owe $102 in a year with interest if you don't pay back that $100. So how can you avoid them? Well, you can avoid them by paying your balance in full by the due date, which we will talk about right here. So how credit cards work. Essentially, you're going to get your statement at the beginning. I usually get a text message from my credit card company telling me that I need to pay my bills, and it's going to include all the transactions for that month. It's going to include the previous balance, your new balance, a minimum payment that you need to make, and the due date. So when you need to pay your bills. And then you have a grace period, which is a period of time between the date of purchase of your card and the due date. So if you pay by that date in full, you won't have any interest accruing. And then to make sure that you pay your bill in full but month to month, so that you don't have that interest accrue, I'd like to point out in that minimum payment that interest is still going to accrue on the balance that you haven't paid. So even if you pay that minimum payment that they require, you're still going to have interest accrue on what you haven't paid yet. So that's why we really focus on paying all of your debt. And how to stay out of debt, essentially. We focus on a lot of the good things like building your credit score that credit cards can do, but I'd also like to point out some of the big risks. So the first risk is getting into debt. How to mitigate that is recognizing the signs that you're heading into debt. So not being able to pay in full each month is definitely a big sign. And then interest can make it harder to pay off your balance. So pay your balance in full each month, but if interest does accrue, do not continue to spend until that balance is at zero to stop the interest from accruing. Since if it keeps on adding it up and up, you can keep accruing that debt and you might not be able to pay it off. And there's also a big temptation to overspend with credit cards since you're not really seeing that money. So I recommend treating the credit card like a debit card. So you only are going to spend what you have in your bank. You can also set spending limits within the card's limitations.
So now you might be wondering where you as a student should get started with all of this information. So the first step would probably be getting a credit card. So when you're applying for a student credit card, the first step you're going to want to take is to check your credit score. I know for me, on my mobile banking app, through my bank, my just regular checking account, it tells me my credit score. If you can't find that information, I would suggest calling your bank or calling whoever might have that information based on your banking situation. And then you're going to want to go online and compare a lot of the starter cards. You can just Google student credit cards and they all pop up, and there's a bunch of websites with lists about that. And then next you'll want to apply online, and everything's online nowadays. So you'll need your social security and other documents that prove your identity. If you don't get accepted to one based on their approval ratings, don't be afraid to apply for others, but definitely only apply for one at a time because you don't want to open up 4 credit cards at once. And then some of the perks to look out for when applying for student credit cards are no annual fees. So an annual fee is a one-time payment that you have to make every year to be able to use the card. And so you want to avoid that. Most of them do. I don't think I've seen a student credit card that has that, but just be sure to check that. Some credit cards have minimum spending limits, like we've referenced earlier, but you can get out of that option if you get the student credit cards. A lot of them also have rewards for good grades. So mine gives me $20 of free credit that I get to use every year if I have above a 3.0, I think. And then there's late payment forgiveness and fraud protection, which are both very good for getting started to make sure that you don't have anything bad happen to your identity or your credit line. If you want to study abroad, it would also be probably smart to find one that is good for international use, because if you have one that's not really rated for international use, you'll get a lot of fees. And then cash back. Most cards nowadays have the cash back option, but you'll just want to compare, is it a flat rate on all items, a low 1%, or maybe there's rotating items like food delivery, grocery, gas, that you get certain special cashback rates on for different times of the year. And then here are some beginner cards that we just compiled that I think are the best options to really get started with. Discover is a really popular first credit card. The Discover It Student Chrome has no annual fee and like the flat cashback rate. It also has a good grade reward. The student cashback credit card from Discover has one of those rotating cashback fees or rates where you get different items, like I said earlier, have different rates different times of the years. The Deserve EDU MasterCard for students is like the best card for international students. It has no annual fee and it has like the flat cashback rate with it. The Chase Freedom Student Credit Card is what I got. I bank through Chase, so it was really easy for me to get approved, and it all kind of fits seamlessly into my banking app. So that might be something to consider is if your bank has a credit card that runs through it. It has signing bonuses, a flat cashback rate, and it also gives credit score insights. So like I can see what I'm doing, what I could do to better my credit score. Then the Bank of America Travel Rewards credit card, it doesn't run on cashback. Instead, it uses airline points or miles. So in the future, I know we can't fly a lot right now, but in the future, if that's something that you are passionate about and you want to save money on, that would be a good option to go for. And all of these have no annual fee and they have a lot of fraud protection because they know you're starting out. So I don't think you could go wrong with any of these. It's just kind of picking what you think you would benefit from the most. And the last thing to kind of know about credit cards is how the tier system works within them. So obviously when you're starting out, you're not going to have like the same amount of credit and like the credit history that your parents have. So student credit cards are going to fall in the tier 2 right here with the no annual fee cards. Tier 1 are starter cards, and those are mostly for people who have had like identity theft or they've just kind of wrecked their credit and they really need to rebuild it from the bottom up. So the good news is that most of us will start at tier 2. We don't have to like build from zero. Tier 3 are going to be the mid-tier cards that you could probably get once you start opening up some more loans later in life, like right after graduation or even maybe senior year if you start early with your credit cards. Some of them might have minimum spending limits, but most of them try not to do that or annual fees. Once you get to the premium cards, I know this is like what my parents have and the majority of my friends' parents have. They mostly have annual fees and minimum spending limits, but it kind of makes sense when you're making a certain amount of money what you have to spend. These you don't have to get invited to, but you do need like a substantial credit history and like loans that are taken out as like other credit measures to qualify for those. And then tier 5 are going to be like the invitation only cards, like the Amex Blacks that you hear about that are like very high and exclusive. You have to spend a lot, earn a lot of money to get those. So that's something to consider when thinking about how you want to move forward in your credit journey.
All right, so loans are when money is given in advance in exchange for a repayment at a certain time of the original value of the loan plus the interest that has accrued. And a default in a loan is when the borrower fails to pay back the loan amount that was stated in the loan agreement. Similar to credit cards, loans also have interest rates. And in regards to loans, the interest rates are the percent that the lender charges to borrow the money. Lenders can use your credit score, credit history, the length of the loan, your income, and more to determine this. There's 2 types of interest rates, and there can be fixed rates or variable rates. Fixed rates are rates that remain the same throughout the life of the loan, and variable rates can change depending on the prime rate, which depends on other loans in the economy and how other loans are doing at that certain point of time. And these are usually riskier because although the rate might seem lower than a fixed rate, when you're taking out the loan, they can always change. And so it's a little bit riskier because it might end up being a higher rate soon into the life of the loan. Credit scores can often be used to determine if you get approved or denied for a loan, and a 660 credit score is normally what is needed to be approved. And sometimes they can also be used to determine your interest rate. If you have a lower credit score, you're at higher risk to the lender for not paying it back. They can't trust you as much, and so they'll give you a higher interest rate. And you can go down up to 5 points when just applying for a loan because they can't be sure, or you're already taking out the loan, so you could have the chance of not paying it back. And then loan terms are the length of time that it will take for a loan to be completely paid off. And these are also called maturity of loans. Short-term loans are obtained for temporary personal reasons or for business capital. And the due date is usually within 1 year and uses a variable interest rate. But long-term loans are where the term's over a year, usually 5 to 25 or more years, and they typically use a fixed interest rate.
Great. So when we're talking about long-term loans, I think it's important to mention amortization. So this concept can be a little much. I know that we talk about it in my finance classes, but I just kind of want to introduce this to you guys. So if you don't understand it completely, that's totally fine. Amortization is essentially when the type of the loan is scheduled. You have periodic payments that are applied to the loan's principal amount and interest accrued. So that principal amount, I'm going to talk about it a little more, but it's essentially the amount that you're asking to borrow and your interest that you're accruing through borrowing that for an extended period of time. So these loans are long-term. They're usually like auto, home, and personal loans, which we'll talk about in a second. And they fall under a loan schedule, which essentially just pays the interest that you're going to accrue off first, and then it goes towards paying off that principal amount, that original amount that you're borrowing. So as the interest portion of the payments are decreasing, then the principal portion is increasing, which I'll get into that in 1 second. But I also want to cover the difference between these loans and credit cards. So amortized loans are generally paid off over an extended period of time with equal amounts paid for each period. There's always an option to pay more of them or refinancing, which we'll talk about later. While credit cards are also known as revolving debt, so they don't have set amounts or a fixed loan amount since you're just borrowing them within like your established limit, so the amount varies. A good way that I think of explaining this is through an amortization schedule. So you don't have to know all of this stuff, but I'll just explain how it works. So originally, we're going to look at the first year of a 30-year mortgage. It's a long time, in the amount of $165,000 with that annual percentage rate of 4.5%. So that's how much interest that they're charging you. This is going to be your payment amount. See that it's fixed each month. And this is how much of the principal that you're paying off of it versus the interest, right? So how you calculate these is essentially you're going to take that $165,000 and multiply it by that annual percentage rate divided by 12 since it's per month. And that's how you're going to get your interest rate right over here. And then whatever is left from that payment amount is paying off your principal. So see that the balance keeps on going down. So your interest keeps on going down, and then you're paying off more and more of your principal amount. So that's how an amortization schedule works. And I would like to point out that you don't really have to know all of this, but here is a quick calculator that I found online. So you can put in your amount, your mortgage term, so it's 30 years, and then 4.5%. And that's how much your monthly payments are going to be. So you don't have to like create a whole Excel spreadsheet to do so. It's just to show you guys the concept of it.
Okay, so I know in previous workshops we've talked about when to save versus when to invest, but obviously some of you are going to have college loans from undergrad, or you're going to grad school. So you've highlighted that you're also concerned about, knowing how to prioritize those three things. And first, I'd like to say you can do all three at once, but just kind of focusing in on your priority with that. So when to pay off debt, this is especially important. You need to look at the interest rate, because if you have a super high interest rate on your like student loans or something, and that loan is just growing and growing, you don't want to ignore that and then be investing in something only giving you a 5% return back. You kind of just have to weigh like the return on both of those. And then when to save, this is kind of like when we talked about your emergency fund. So that's usually 6 months of your like bare bones living expenses. Obviously you need to pay off your debt, and it's important to invest for the future, but you don't want to be hit with something unexpected, like losing your job, or like suddenly you need to get like new tires for your car and not have the money to do that when those are immediate needs. And then when to invest, this is kind of when, if you want to focus on that, if the return on your investment would be higher than any debt you had, or if you just had additional money after you paid off, the debt you're comfortable with month to month, and then had a good emergency fund. Okay, so I'm going to talk about 4 common loans you'll take out throughout your lifetime. So again, student loans, probably a lot of us have them, and even into grad school, you might be concerned about those. You'll probably have to take out an auto loan, your mortgage, which is just the loan on you use to purchase your house, and then any personal loans. Okay. So first thing with student loans, I'm going to talk about subsidized versus unsubsidized. So subsidized loans, you have to qualify based on your financial need. And these are kind of advantageous over unsubsidized loans if you do qualify for them, because the U.S. Department of Education pays the interest on them while you're in school. So, all 4 years for undergrad, and then 6 months after, they give you kind of a grace period to like get on your feet, so you don't have to worry about the interest. And then your school determines the amount you're allowed to borrow just based on your need, based on tuition, things like that. And then with unsubsidized loans, there's no financial need requirement, but you are paying all of the interest. So you're responsible for that. And you might even want to start paying those off while you're in school, because the interest is accruing and you have to pay all of it off yourself. Okay, so now we're going to do public versus private. So, federal loans or public loans, you go through the government, and they do not look at your credit score, which could be advantageous again, because, when you first start out, your credit score, it wouldn't be as high as your parents say. And these also might have this grace period, like I talked about with the subsidized loans. So again, it just gives you time to, get on your feet after you graduate. And have some money to pay the interest on that. And then private, you can take out through a bank. This does look at your credit score and credit history. So that's a little tough sometimes, again, like I just mentioned. So your parents usually have to co-sign on these, and you have to start paying these back immediately. So there's no grace period. Okay, and then this slide is just highlighting the difference between undergrad and grad school loans. So basically when you're in undergrad, you're usually dependent on your parents, you use their credit score and things like that. But with grad loans, usually you're considered independent when you file, when you have to like fill out your FAFSA. They typically make you pay a higher interest rate because, again, it's all on you and you're a little riskier since you're younger and don't have credit history. But you might qualify for like better rates on private student loans. So that might be something to look into if you're going to grad school. There are higher borrowing limits just because grad school is usually a little bit more expensive. And there are no subsidized loans. So none of those loans that the government is going to help you pay interest on. And there is also something called student loan refinancing. I'll talk about this a little bit also when I talk about mortgages, but this is basically when, if you've been paying off your student loans for a few years and you decide, hey, I'd like to have, I'm making a little more money now, or I got a part-time job, I can pay more each month. So they'll kind of change the terms of it. They'll change your rate, your payment, things like that. But I'll talk more about that with mortgages. Okay, so car loans. I know I will be buying a car in the next couple of years. So the average interest rate with these are 3 to 10%. And used cars tend to have higher interest rates just because they have lower resale values, and then they're riskier since they're potentially less reliable. And the car is used as collateral. And what collateral is, it's basically kind of like the guarantee that you're going to pay back the loan. And if you do not pay back the loan, so if you default, they can come and take your car from you. So basically it's just some protection for the lender. And then you set your rates and payment schedule for those as well. Okay, so this is about mortgages, which is the loan for your house. The average interest rate is 4%. Again, when you take out the loan, they'll set your interest rate, they'll set the term. These are usually really long term. I think my parents took out theirs for a 30-year maturity. Some people do 15 to 20, but very long term because houses are expensive. And in this case, your house is the collateral. So if you don't pay that back, they come and take your house. And then, so now I'll talk about refinancing, because this is the most common with mortgages, I would say. That's how I've heard of the term originally. So basically, say you set the loan to have a maturity of 30 years, and maybe you're making $100,000 originally, but then you get some raises and suddenly you're making $150,000 and you can pay more each month. So you might change the maturity on that. So then they would kind of adjust the rate, the payment schedule. And reasons you would do this, first I already mentioned, if you're able to pay more each month, but also borrowers tend to refinance when the interest rates fall. So then you're paying less interest. That's basically the idea with that. And then they'll look at your credit history, how well you've been repaying the loans, and look at your credit score again, just kind of reevaluate how you're doing paying back the loan. Okay, and then just for personal loans, you might want to take these out if you're planning a wedding, you need money to do a big move, or just home renovations. I really think it can be for anything. The interest rates really vary on these, though. It's just 10 to 28%, which is crazy. So secured personal loans use collateral, just like I talked about, the car is collateral for auto loans and your house is collateral for your mortgage. They'll sometimes use those things as well, or just something else valuable. And then unsecured is when they don't use any collateral. It's just your rate is based on your credit score. So basically, if the lender is secure with your collateral, or the lender is kind of unsecure in that case.
Great. So we've included our Instagram there. You can add us on the hub to get onto our mailing list. And that's how we send out all of our meeting stuff. And then we also have a website. So muwwi.com. And we have all of our workshops on here. We have different resources. We have market updates, which is a new slide by our editorial team, and other resources that you can gain like when you want to start investing and stuff like that. So now we're going to open the floor to questions that anyone has.
I have a question about car loans. So mortgages tend to be like 15 to 30 years, so an average term length for car loans.
Definitely a lot shorter than that. I would say like under 10 years. I know my boyfriend just took one out, and his, I believe, is 5 years, but it's just kind of based on what you are paying each month, how much the car is worth. But they kind of vary, but a lot less than mortgages.
I have a question about mortgages. So once you pay off like the mortgage in full after the certain amount of years, are you then a homeowner, or does like the bank still own the home?
No, once it's all paid off, you're technically free from those mortgage payments, which can be very expensive sometimes, but it takes a long time.
I remember when I was like a little bit younger, my parents like refinanced the mortgage on our house, and I'm pretty sure they just switched like which bank it was with. So do you know if different banks offer different interest rates?
Yeah, well, I think it's just kind of based on like maybe where you have accounts. But I think my parents just have it through like one of the banks they have a credit card with. But I believe then they like refinanced it with my aunt who like worked at Wells Fargo prior to their whole little debacle. But yeah, you can, I think it's just based on basically how the bank views your credit history and payment history.
Okay.